Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Good day, everyone. Welcome to another financial podcast from the Cambridge Financial Podcast channel. My name is Bert Salazar, and today's podcast is going to be the role of insurance in a successful financial plan. As we engage clients on a regular basis, and this is something that is applicable to all Americans in this country and throughout the world, the area of insurance becomes a very critical aspect of financial success. And that does not matter whether you are 20 years old or 30 years old or 50 or 60, 70, 80 years of age. It really doesn't matter because insurance plays a major role in everything that clients do on a regular basis. One of the main things that we do here at Cambridge is that we have a very straightforward mission and vision. And at Cambridge, our personal mission is to mitigate financial risk by sharing philosophies that are based on proven economic principles, which means that every financial decision that we earmark for the clients or that we ask our clients to take have to be based on proven economic principles, because things are bound to change at any point in time in someone's life or someone's financial career or someone's business. But as long as you maintain your economic principles in view, then there's a very, very high probability that clients are going to be successful. You know, there's an old saying that people have a tendency to see obstacles when they lose sight of their goals, and that's a very true statement, because we see this on a regular basis with our clients and friends along those lines. You have to stay very true to all the financial decisions that you make, and obviously the more those decisions are earmarked based on economic principles, the better the chance of success. Now, there are four major risks that Americans are facing today, and I know we've talked about these in other podcasts that we have done, but the four major risks that our clients are facing today are primarily the risk of dying too soon, the risk of living too long, the risk of living with a disability, and last but not least is the risk of living with eroding factors. Now, the risk of dying too soon is a critical one, not only for clients that are in the process of accumulating assets for retirement, but also for those clients that are already in retirement. And what do we mean by that? Well, if you die too soon, there's a negative impact that takes place not only for your family and your business, but just about every single asset that you may have in your portfolio. So having the ability to protect yourself and your family from the risk of dying too soon is a very critical one. And I'm going to kind of walk you through the different components of the protection model that we use with each and every one of our clients. The second risk is the risk of living too long. Now, that is one of the major problems that we have in the United States today. People are living a lot longer. You know, what used to kill us, as I've said before, 30, 40 years ago is no longer killing us. Now it may leave us disabled, but at least we're still alive. And if you're 65 years of age today, you have to plan for at least 3 decades of retirement. And all the planning that you do has to bear in mind the negative impact of living too long. If dying too soon brings negative impact to a family as a whole, living too long may also create some of the same issues and concerns along those lines. Now, the third risk that we manage on behalf of all our clients, and that we feel very strongly that Americans should manage, is the risk of living with a disability. What may not kill you today may leave you disabled. And how are you and your family going to be able to cope with the issues and the concerns of disability in the future. Not only the caring, but also the cost of disability benefits are increasing on a very fast pace every single year. And last but not least is the risk of living with eroding factors, and those are, taxes, inflation, preponderance to consume, litigation, interest rate volatility, stock market volatility, and all the eroding factors that are facing us every single day of our lives. Now, the LEAP model that we use, and we've talked about this in another podcast, has pretty much three major components. It's got the protection component, a savings component, and the growth component of the model. Today we're just going to talk about the protection side, because protection is the one area in the model that we find that our clients have really not done a very good job at. And they haven't done a very good job at it, not necessarily because they intended not to do a good job, but I think it's primarily because of lack of education many times and lack of information from a business perspective. I can tell you the following. If you use an analogy of football, you would be able to say that protection is gonna be able to win Super Bowls. Defense wins Super Bowls. Offense, which would be the savings and growth components of the model, puts people on the stands. So at the end of the day, those teams that create the least amount of errors and create the best type of defensive game that they can possibly put together usually have a tendency to win the Super Bowl. The same thing happens on your financial life. Now, our protection component, the one that we pay attention to as we're working through our clients, has 9 major areas there. So you have vehicle insurance, property insurance, liability insurance, disability insurance, medical insurance, and that includes not only traditional health care, but also long-term care along those lines. Government plans, Social Security, Medicare, and the like. Wills and documents, trust and ownership, if the client has specific corporations that he or she may own. And then last but not least, life insurance. So all of these areas are very critical in the type of work that we do with our clients as we embark of doing life insurance and insurance component audits whenever we engage a client for the first time. So what are some of the things that our clients and Americans need to pay attention as they're going through the insurance component? So for instance, when it comes to automobile insurance, critical questions that need to be addressed. Are the vehicles owned or are they leased? What are the liability limits with the premiums and deductibles that the clients are paying? We have many clients that come to our office, and when we ask them their liability limits on their insurance automobile protection, they have no clue. Now, just to give you a little bit of feedback, let's say that you have a lease vehicle in the United States. If you do have one, you need to have at least 300 of liability protection. Now, that means $100,000 per person in the vehicle, and a maximum of $300,000 per all people in the vehicle at the time of the accident. So let me give you an example along those lines. So if you are driving down the street and you run a red light or you run a stop sign and you get involved in an accident in which you are at fault, the insurance company that has $100,000, $300,000 of coverage will pay $100,000 of liability protection on your behalf to any one person that was involved in the accident or that was injured in the accident. But the maximum that they will pay will be $300,000. So let's say that I am the person involved in the accident. someone listening to this podcast, you ran a red light and you hit me, and I am now either totally disabled or I'm dead or I'm partially disabled, but at the end of the day, the amount of damages exceed $100,000. So let's say that my damages are, $500,000. Well, if the damages are $500,000, the most that your insurance company is going to do is going to tender their liability limits, which in this case would be $100,000. So the question to all of you is, who's going to pay the other $400,000? Well, you will pay the other $400,000, and it's going to come from, some assets. So one of the first questions that I ask clients when we do these types of audits is, Mr. Client, or Mrs. Client, if you have an at-fault accident exceeding your liability limits, how will it be paid? What assets will you have at your disposal to pay the additional $400,000 that the insurance company did not pay? Remember, in $300,000 is $100,000 per person that was injured, maximum, and $300,000 maximum for everyone in the vehicle. So if you had 4 individuals in my vehicle when you hit me and it was your fault, and they all got injured badly, and the damages exceed, let's say, $1 million combined for all 4 of us, your insurance company is going to pay $100,000 per person for the first 3 people in the vehicle and nothing else. So all the other damages are going to come from your personal assets. And then the big question is, well, if you have no idea how you're going to pay for it, or you have investments or vehicles at your disposal to pay for this, the next question is, are your assets protected from creditors? So you may be doing a really good job in maximizing your investments with your stockbroker, and he or she may be doing a good job for you, but if they're not protecting your assets, then those assets can be gone just overnight because of some liability that you may have caused to somewhere down the line. The other question that we ask many of our clients as we do these audits is, we say the opposite way. We say, well, Mr. Client, if you were driving down the street and a Coca-Cola truck ran a red light and they hit you and they killed you, how much should your surviving spouse and children sue Coca-Cola for? Now, one of the questions that we automatically get is, well, we want to sue Coca-Cola for as much as we possibly can. But it doesn't work that way, because you as an individual, you have an economic value. And usually, I'll give you an example. Let's say you're 45 years old, you want to retire at 65, you make $100,000 a year today. So if I'm just using simple math, you're 45, but you died today. So therefore, you have 20 years that you could have worked, and you could have provided for yourself and your family that you are no longer capable of doing. So if I do simple math, I'll say $100,000 a year that you're making today times 20 years, that's $2 million right off the bat. Plus we have to add an inflation factor there, because you may be receiving, depending on the type of business that you're in or the type of employment that you have, pay raises and or merit base increases along those lines. So someone that is earning $100,000 today, when it's all said and done after we do the calculations, may have an economic value of $2.5 to $3 million over the next 20 years. So those are things that we pay attention to when we do these insurance audits on behalf of our clients. The second area is homeowners insurance. And the same thing, what are the liability limits there, along with the premiums and deductibles? Now, when we get into the deductibility of property insurance, as we also do when it comes to automobile insurance, most clients that we engage, when we ask them is, how did you choose your deductible? They say, well, I have no clue. The agent told me that I should have $250 deductible, and that should be it. My issue with that, and the issue that we address here at Cambridge, is look, Mr. and Mrs. Client, if you have a fender bender or you had some minor damage in your home that is $250, are you going to fix it yourself, or are you going to report it to the insurance company? And 99.9% of the time, the answer that we get from the client is, no, Bert, we're going to pay for it, because if we were to report this a fender bender to an insurance company, then they're going to be raising our premiums in the future. So then my question is, well, at which point in time will you now be able to say, I definitely need to report this to the insurance company because I don't want to pay any more money? Is it at $250? Well, the answer is probably no. Is it at $500? It may be not. Perhaps once you get to $1,000, you say, well, if the damages exceed $1,000, then I'm definitely going to report it to the insurance company. So if that's the case, if you're never going to report damages for $250, why are you someone with insurance protection either in your home, which obviously the deductibles are higher, or your personal auto liability, why would you want to pay a higher premium for a lower deductible that you're never going to use? I would rather have you increase that deductible and use the premium savings to put somewhere else in the model. So these are the type of questions that we ask our clients, and many clients have never thought of it, and they thank us very much by the fact that we're able to save them money along those lines. Now, the same question occurs in homeowners insurance. If you have an at-fault accident that exceed your liability limits in your home, how will it be paid? What if you have a swimming pool and someone fell in the pool and drowned? How are those damages going to be paid? And what kind of a job have you done, or have your advisors done, in making certain that all the assets that you have are credited protected? Now, that brings me to another point. There's another type of coverage out there is called umbrella liability insurance. Interesting enough, the majority of clients that we engage and the majority of Americans that we talk to have never engaged any type of umbrella liability policy. And umbrella liability policies, especially for the type of clients that we deal with, are extremely important. Because what umbrella policies do is they hover over your auto insurance policy and over your homeowner's insurance policy. So in that first scenario that I gave you, where one of you got involved in an accident with me and I'm either totally disabled, partially disabled, or dead, where the insurance company representing you for your auto insurance policy may pay the liability limit per person of $100,000, but my damages were $500,000, and you're asking yourself, where is the other $400,000 going to come from? Umbrella policies, if you have the proper coverage, will now be able to come in and pay the additional $400,000 without you, the client, have to, and or insured, having to dip into your personal savings or have your personal savings susceptible to litigation, and you may lose them all the way. What's important to note about umbrella policies, usually I try to recommend to my clients that they buy one time whatever the value of the assets are, at least $1 million. And the premium for these umbrella policies are very, very reasonably priced and very low as compared to homeowners insurance and auto insurance. And the reason for that is simple. These types of coverages do not come into play until the underlying coverages of your homeowner's policy or your auto insurance policy have been exhausted. So it's an excellent tool as an asset protection tool that all of you should consider. Now, the same applies for disability. Many people have all kinds of insurance contracts on their lives but they don't have disability. And more than likely, the most important coverage that you could have is that of disability benefits, because we have a tendency as Americans to insure everything that we own. We insure our cars, we insure our lives, we insure our properties, we insure our investments, but yet the most important asset that all of us have, which is our ability to wake up in the morning and go run our business or go to work and earn a living in order for us to be able to purchase and pay for everything that we own, we very seldom protect. So I've been a business owner for almost 30 years. I've had disability coverage for each and every one of those years, and it's personally owned. Now, in disability, you could have a group benefit. So if you happen to be an employee in a corporation and they offer disability benefit programs or any type of employee benefit program, you may be able to purchase disability policy as a group. Now, because it is a group, the premium is lower. If the employer pays for the premium, then if you do become disabled, more than likely the benefits are going to be taxable to you. If you do pay for the disability premium yourself 100%, then if you do become disabled, the benefits are tax-free to you. And if the employer kind of co-shares with you the premium payment, then whatever portion of that payment was made by you, that same ratio of portion of disability benefits then will be tax-free to you, and then the rest will be taxable. Disability coverage is one of the most important coverages that Americans should have today. And obviously, it's critically to understand the disability benefits and the duration of the disability. There are many different types of disability duration that you can purchase in the marketplace, and also the elimination period, which is how long before the policy will kick in and pay benefits. You also need to understand how the benefits are triggered and if they provide residual benefits and so forth. One of the things that is very critical to understand once we go through this podcast is that it's very important for you to do an audit of all of your insurance program at least once every 3 years. We normally recommend, we do it for our clients on an annual basis anyways, but these are clients that are already working with us. But if you're not working with us and you're working with someone else, at least every 3 years you should be paying attention to your insurance audits and your insurance benefits. Now, the next one is medical insurance, and obviously most of us understand that. But also in there, long-term care plays a major role because, we are living a lot longer today than ever before, as I said earlier. Therefore, there's a high susceptibility for long-term care benefits in the future. The question is, do you know how the benefits work? What is the benefits duration and elimination period? When it comes to long-term care, there's something called ADLs, which are the activities of daily living. Most plans allow that if you cannot perform 2 of the 6 activities of daily living, like bathing or continence or feeding yourself or whatever that may be, you may very well qualify for long-term care benefits. So it's critically to understand that. If you don't have long-term care, I would encourage each and every one of you to do some research. There's a lot of different companies in the marketplace that can help you with that. We can also do that at Cambridge, but it's very critically important to make certain that you have proper long-term care benefits. You can buy standalone long-term care policies, or you can choose certain insurance programs, like certain life insurance programs that have chronic illness and disability and long-term care protection riders as well. Now, your government plans, this is your Social Security and Medicare. Now, obviously, the question is understanding, how do you pay for that? Just for your information, if you're an employee in the United States and you get W-2 income and you get paid through an employer, you're going to be paying 7.65% out of pocket for Social Security and Medicare. Out of the 7.65%, 6.20% will be earmarked for Social Security and 1.45% will be earmarked for Medicare. Now the 6.20% of Social Security, you will only pay that up to the taxable wage base, and that increases every year. It's north of $117,000 today. But once your income exceeds that amount, then you no longer pay the 6.20%, but you will continue to pay the 1.45% for Medicare premiums for as high as your income may be. So if you earn $2 million a year, you will pay 1.45% on the entire $2 million. Now, also the key determination is, what percentage of your Social Security benefits are taxable. As a matter of fact, we do a weekly webinar. Feel free to send me an email at bert.salazar, SALAZAR, at Cambridge, F as in Frank, P as in Paul, LLC.com, and I will send you a schedule of all the different webinars that we do as far as taxation and retirement and the taxation of Social Security benefits. Another major issue in this area is, when do you think you want to retire? When will the benefits be triggered? Does it make sense for you to retire at 62, 65, 67, or 70? And the answer is it depends. It depends on your finances, and it depends on your tax liability and ultimate goals. Do you know how survivor benefits are paid under Social Security, and so forth? Now, another major issue in protection that we deal with when it comes to our client audits is the area of wills and documents. Questions that we ask is, do you have a will? Do you have a living will? Do you have durable powers of attorneys, for healthcare proxies and so forth? When were the wills established? When was it last reviewed? We have had clients that have had wills for 15 years, and a lot of stuff has changed in their lives, yet they have not updated their wills. Just so you'll know, if you live in any state of the union, everyone has a will. Like in the state of Florida where I live in, we fall into the intestacy laws of the state of Florida. But it may not be the type of law that you may want to apply to yourself and your family at time of death. So we encourage each and every one of our clients to make certain that they have their proper wills and their proper trusts in order to keep everything private, in order to keep everything in an orderly fashion when it comes to distribution, because you want to make certain that your assets are distributed according to your desires and not according to the desires of the state that you may live in. The next area is trust and ownership. Do you own a company? What kind of corporate structure do you have? Is it a corporation? Is it a partnership? Is it an LLC? And there are many issues and concerns that deal with that we're not going to get into today, but these are things that are very, very critically important to be able to understand from a business standpoint. One of the major areas that we get into is in the area of life insurance, and here we do a strategic auditing along those lines. So one of the first things that we do when we engage with clients is find out if they own any life insurance. If they do own insurance, do they know what kind of life insurance do they own and how it works? I mean, there are many different clients. Obviously, traditionally, you have your term insurance contracts, you have your whole life, you have your universal life, you have your variable universal life, and you have one of the latest ones in the marketplace, which hasn't been around that many years, is index universal life, and they all work totally different. Now, one of the questions that we get asked all the time is, well, Bert, what is the best type of life insurance that's available in the marketplace? And my answer is always the same. The best life insurance policy that you can have is the one that happens to be in place the day you die or the day someone dies. So obviously, if you die tomorrow, term insurance that you bought today will pay a death benefit, as long as obviously it's not for suicide, because suicide carries a 2-year contestability period. So you have to wait 2 years before you commit suicide. And even if you wait 2 years and you commit suicide, insurance companies are liable and they have to pay a death benefit, even if you took matters into your own hands. Are you paying too much for your life insurance policies? I have reviewed life insurance contracts that were issued under the 1980 CSO rules, the Commissioner's Standard Obligation, and that is the company that dictates the rates for insurance contracts based on how many people die in the United States on an annual basis. Now, in 2001, the new rates came into play. So you could be older than when you first bought your policy, but because the rates are somewhat cheaper, because people are living a lot longer today than they did 30, 40 years ago, on a per thousand basis, you will receive a discount. Do you own the right kind of life insurance for your personal and business needs? And that's another major issue that we deal with our clients. In part of the audit process that we conduct, one of the things we attempt to do is we want to make certain that we can reduce the internal cost of life insurance policy contracts that our clients own. Another major area that we deal with when we do insurance audit is that, many times life insurance policies are lapsing and clients are not even aware. So we send letters to the insurance carriers that have our clients' policies, and we demand an in-force illustration from them, because many times clients have been underfunding or underpaying their life insurance contracts because either they were not sold properly, or clients have had financial issues along those lines and they have reduced the premium. But if you continue to pay the same premium, if you thought your policy was going to be alive until the age of 95, you may find that in 5 years from now that policy is going to lapse unless you start putting a lot more money in, and you want to know that now, you don't want to know that later. Another thing that we use life insurance policies for inside a successful financial plan, whether it's pre-retirement or post-retirement, is using life insurance as asset insurance. And let me give you an example. Let's say, my wife and I, we have, let's say, $1 million in assets at time of retirement. Well, I'm going to live, if I don't have any type of life insurance protection or survivor benefit protection, I'm going to have to live off the interest that $1 million generates. And I don't care if the interest is in a CD making 2% or 3% or 4%, because I also want that money to be guaranteed. And what happens? I want to make certain that I can use that money to maintain my standard of living and that of my family. And if I were to die tomorrow, that $1 million has to be there in order to continue to provide survivor benefits to my wife, in this case, Maria, until the day that she dies. Now, she could die first and I could die later, so the example will apply on both sides of the ledger. But the issue is, if I had $1 million of guaranteed life insurance, then now I have a lot more leverage. I can go to an insurance company with my wife, I can take my $1 million, I can buy an immediate annuity in which the insurance company now is going to start paying me not only the interest, but a portion of my principal as well. So now my income is greater than it was because I was only receiving interest and not principal, because I couldn't have invaded the principal in my previous example, because once the principal was gone and I died, my wife would be totally without any money whatsoever to maintain her standard of living. But if I have life insurance upon my death, then that life insurance proceed that would be paid to my wife, which would be tax-free in nature, by the way, will now replace all that principal that we used while the two of us were alive. So life insurance is a strategic tool to use in a financial plan. The other way that we use life insurance in a financial plan, and when we do these calculations, we figure out the exact amounts and the reasons for the amounts that we are suggesting, but it's also as a Social Security recovery program. In the same case scenario with me, I earn more money than my wife, so when we're both retired, she's going to take 50% of my Social Security benefits unless hers are higher than that 50%. And upon my death, she will assume my full Social Security benefit, which is the higher one in this scenario. It may be different for those of you on this podcast, but in any event, she can only choose one. So therefore, if while both of us were alive, we were utilizing 2 Social Security paychecks, and all of a sudden I die or she dies, and now there's only one left, well, how are you going to replace that additional income that was coming in that is no longer there? Well, we use a Social Security recovery program in order to be able to do that and recover through a death benefit payout enough amount whereby now my wife can go to an insurance company and buy an immediate annuity that will last until the day she dies, so it's not going to die before she does, and thus she has been able to replace that Social Security income that is no longer coming into the household. So again, these are things that we do when we engage clients from a business standpoint. Now, life insurance and other insurance programs like disability and group benefits, there are business uses as well. Now, I'm just going to touch very quickly on those because we're going to do another podcast for business owners, and we have many as part of our client base in which we're going to go into more details on these benefits. So what are the business uses of life insurance? Well, number one, group employee benefits. So whenever you work for a company, or if you own a company yourself, you may want to provide group employee benefits to your employees, and that would include group life, group disability, health insurance benefit, dental and vision plans, and so forth. If you happen to own a company and you have certain key employees in your company, you may want to provide key man insurance. You want to make certain that you can protect yourself and your firm from one of your key employees passing away or becoming disabled. So we also do disability protection, key man disability as well there. Because, if that person can no longer do his or her job, it's gonna reduce the revenues that is coming into a company. So obviously most business owners are successful, have a tendency to protect what can go wrong before they invest in what can go right. Another thing is you may want to have a key employee that you may want to do something for him or her above and beyond what you may provide for your rank and file. So you may want to create a GIBA, a Golden Executive Benefits arrangement under Section 162 of the IRS Code, which means that you are doing certain things for that employee or that executive that you're not doing for anyone else. And by doing so, you're placing golden handcuffs around that employee because you can set up as to when that employee will have access to those benefits, and therefore you're providing a plan that will limit your executives or your key person opportunity for leaving the company and going to your competitor. Also, we do non-qualified deferred compensation plan. Again, we're going to do more of these and go into more details on these. And then obviously business continuation. If you have multiple partners in a company, you want to make certain that you have a proper drafted, usually through legal means, of a buy-sell agreement and a disability buyout buy-sell agreement as well. You want to make certain if you have more than one partner in a firm and one of them were to either become totally disabled or they pass away, how are those shares going to be distributed? Who's going to pay for those shares? What are some of the legal ramifications of doing those things? So again, the role of insurance protection in a successful financial plan is one of the most critical aspects and that you could have from a business standpoint. That's our specialty here at Cambridge. And again, as we always say in every single podcast, our goal, our number one and primary goal for us here at Cambridge, and for me, as your financial podcaster and advisor, is to get our clients to change the way they see things. Because when they change the way that they see things, the things they see change. So again, we appreciate very much you being with this podcast. Stay tuned for many more of these. We're doing one a week, and we have a tremendous amount of different topics that we're going to be covering between now and the end of the year, and then obviously we'll have the schedule for all of next year as well. So again, thank you so much, and have a great day.